The year the foundation cracked. The year is 2026, and the most important agreement in modern financial history just expired. Not with fireworks, not with a presidential address, not with breaking news alerts. It expired quietly, and that silence should terrify you. Because for 50 years, every single barrel of oil sold on Earth was priced in US dollars. Not euros, not yuan, not gold, dollars. That wasn't an accident. It wasn't natural market evolution. It was engineered, structured, negotiated behind closed doors in the aftermath of a monetary crisis most Americans barely remember. And that system, the system that allowed the United States to borrow endlessly, import endlessly, print endlessly, has just fractured. If you think this is abstract geopolitics, you're wrong. This is your grocery bill, your mortgage rate, your retirement account, your paycheck. Because when the world no longer needs dollars to buy energy, the artificial demand that held up the entire American economic illusion disappears. And once artificial demand disappears, gravity returns. Let's rewind. August 15th, 1971. President Richard Nixon steps in front of cameras and announces something temporary. The United States is closing the gold window. Translation, the dollar is no longer backed by gold. For the first time in modern history, the world's reserve currency is backed purely by faith, and faith is fragile. Washington knew that if foreign governments lost confidence in the dollar, they would dump it. If they dumped it, inflation would explode. If inflation exploded, American global power would evaporate. So they engineered a workaround. In 1974, Henry Kissinger negotiated a deal with Saudi Arabia, the single most important oil producer on Earth. Saudi Arabia would price oil exclusively in US dollars. In return, the United States would provide military protection, weapons, and regime security. But here's the part most people never connect. Once Saudi oil was priced in dollars, OPEC followed. And once OPEC followed, every country on Earth that needed oil, which means every industrial nation, needed dollars first. If Japan needed energy, it needed dollars. If Germany needed energy, it needed dollars. If China needed energy, it needed dollars. That created constant global demand for US currency, which meant America could run massive trade deficits, print money without immediate consequences, accumulate trillions in debt, and export inflation abroad. For half a century, the world absorbed the excess. The petrodollar system wasn't just an oil agreement. It was the hidden engine of American dominance. It allowed the United States to consume more than it produced, to borrow more than it saved, to wage wars without immediate economic collapse, to build an empire financed not by taxation, but by global currency demand. But here's what history teaches. No reserve currency lasts forever. Not the Dutch guilder, not the British pound, not the Spanish silver dollar. Everyone followed the same arc. Dominance, overextension, debt expansion, currency debasement, loss of confidence, transition. In 2023, Saudi Arabia signaled it would not renew exclusive dollar pricing agreements. In 2024 and 2025, they expanded oil trade in yuan. In 2026, the expiration became reality. Oil is now settling in multiple currencies: yuan, rupees, dirhams, even bilateral agreements bypassing the dollar entirely. That shift sounds technical. It isn't. When fewer countries need dollars to buy energy, global dollar demand declines. But the supply of dollars does not decline. In fact, it's exploding. The United States now carries over $36 trillion in national debt. Annual interest payments approach levels that rival defense spending. And when interest rates rise to defend the currency, debt servicing becomes unsustainable. When rates fall to ease debt pressure, inflation accelerates. There is no painless option. And markets know it. Since 2000, dollar reserves as a percentage of global foreign exchange have steadily declined. Central banks are buying gold at the fastest pace in modern history. China is reducing treasury exposure. Russia exited the dollar system after sanctions. India and Brazil are conducting trade in local currencies. Even traditional allies are hedging. This isn't ideology, it's risk management. When reserve currency confidence erodes, diversification accelerates. And confidence is the only thing that backs fiat money. The petrodollar didn't die in one dramatic collapse. It eroded quietly. And quiet erosion is more dangerous than sudden crisis, because most people don't see it until purchasing power disappears. When artificial global demand shrinks, excess dollars come home. And when excess dollars come home, prices rise. Imports become more expensive. Energy spikes, food rises, medical costs follow. The middle class feels it first, then the political system fractures. History doesn't move slowly at the end of currency cycles. It accelerates. And the transition from dominance to multipolar currency chaos rarely feels orderly. The question is no longer whether the system is shifting. The question is how fast. Because 2026 may not be the year everything collapses, but it may be the year the foundation cracked permanently. And when foundations crack, the structure above doesn't fail immediately. It weakens, quietly, until one stress event exposes what was already broken. This isn't about fear, it's about pattern recognition. The petrodollar era defined American power for 50 years. Its expiration defines what comes next, and what comes next will not look like the world you grew up in. How reserve currencies actually die. Reserve currencies don't collapse in flames. They fade, then they fracture, then they're abandoned. The process almost always looks boring in the beginning. That's why people miss it. A reserve currency survives on 3 pillars: trust, liquidity, force. Trust means other nations believe your currency will hold value. Liquidity means your financial markets are deep enough to absorb global trade. Force means you have the geopolitical power to enforce the system. For decades, the United States had all 3. Trust in the dollar, the deepest bond market on earth, and the most powerful military ever assembled. But trust is the fragile pillar. Liquidity can be engineered. Military power can be projected. Trust must be maintained. History shows that reserve currencies don't fail because a rival currency suddenly becomes superior. They fail because the dominant power abuses its privilege. Let's look at Britain. In 1914, the British pound was the undisputed global reserve currency. The City of London was the financial center of the world. Sterling was trusted. Britain controlled global trade routes and a quarter of the planet's landmass. Then came war. To finance World War I, Britain suspended gold convertibility and printed money. Debt ballooned, confidence weakened. After the war, Britain tried to restore the pound's dominance by pegging it back to gold at an unrealistic exchange rate. It didn't work. Over time, countries diversified away. Not dramatically, not overnight, gradually. By the 1930s, sterling dominance was effectively over. By the 1940s, it was replaced. Now consider the pattern: war spending, debt expansion, monetary debasement, artificial pegs to defend confidence, gradual diversification, eventual transition. Sound familiar? The United States has fought multiple large-scale wars in the last 50 years. Iraq, Afghanistan, global counterterror campaigns, without raising taxes to pay for them. Instead, debt. In 2000, U.S. national debt was under $6 trillion. By 2026, it exceeds $36 trillion. That's not linear growth, that's exponential expansion. Meanwhile, the Federal Reserve expanded its balance sheet dramatically after the 2008 financial crisis. Then again, during the pandemic, trillions were created. And because the petrodollar system maintained artificial global demand, the inflationary consequences were muted, temporarily. But once reserve currency status weakens, money printing becomes visible. The world no longer absorbs the excess quietly. Here's how the process unfolds. First, central banks reduce exposure slowly. They don't announce it, they just rebalance. Second, trade agreements diversify. Oil trades in yuan. Bilateral settlements bypass the dollar. Third, interest rates rise to defend the currency. Higher rates strain debt sustainability. Fourth, political instability increases. Economic pressure feeds polarization. Fifth, a catalyst event accelerates the shift. It could be a financial crisis, a geopolitical conflict, a debt ceiling standoff, a banking panic. Reserve currencies don't die because they're replaced cleanly. They die because confidence decays, and alternatives become good enough. The dollar still dominates today, but dominance is not permanence. The percentage of global reserves held in dollars has declined steadily for 2 decades. Gold purchases by central banks are at historic highs. BRICS nations are actively constructing alternative settlement systems. None of these alone end the dollar, but together they represent erosion, and erosion is invisible until the structure weakens beyond repair. The dangerous myth is that reserve currency status is permanent. It isn't. It is rented. And the rent is paid through fiscal discipline, geopolitical stability, and monetary credibility. When those weaken, history moves. The United States still has enormous structural advantages: innovation, military power, financial depth. But it also has record debt, rising deficits, and a political system struggling to pass basic fiscal reforms. Reserve currencies don't collapse because they are attacked. They collapse because they are mismanaged. And when confidence finally breaks, the transition doesn't wait for permission. What de-dollarization actually looks like. Most people think de-dollarization means one dramatic announcement, a headline, a press conference, a rival currency replacing the dollar overnight. That's not how it works. De-dollarization is quiet, technical, incremental. And by the time the public notices, the structural shift is already well underway. Let's strip the emotion out of it and look at mechanics. For 50 years, global trade followed a simple formula: energy priced in dollars, commodities priced in dollars, shipping contracts in dollars, debt issued in dollars. That created automatic demand. If Brazil wanted oil, Brazil needed dollars. If India wanted fertilizer, India needed dollars. If Germany wanted LNG, Germany needed dollars. The first step of de-dollarization is not replacing the dollar. It's reducing the need for it. And that's happening. China and Saudi Arabia have settled portions of oil trade in yuan. India has purchased Russian oil using rupees and dirhams. Russia now conducts the majority of its trade in rubles or yuan. Brazil and China agreed to settle bilateral trade in local currencies. None of this ends the dollar, but each transaction reduces marginal demand. Reserve currencies don't collapse because 100% demand disappears. They weaken because 5% demand disappears, then 10%, then 15%. At scale, small percentages matter. Now look at central bank behavior. Central banks are not ideological. They are risk managers. And over the last 3 years, central banks have been buying gold at the fastest pace in modern history. Over 1,000 metric tons annually. Why? Because gold carries no counterparty risk. It is not dependent on U.S. fiscal policy, not dependent on sanctions, not dependent on treasury auctions clearing smoothly. When Russia's dollar reserves were frozen in 2022, something changed globally. For decades, U.S. treasuries were considered untouchable, neutral, safe. After that event, every nation outside the Western alliance asked a simple question. What if we're next? And once that question exists, diversification follows. That's de-dollarization. Not rebellion, risk management. Now, let's talk about treasury demand. The U.S. government finances deficits by issuing bonds. For decades, foreign governments absorbed large portions of those bonds because they needed dollars for trade. If global dollar demand slows, treasury demand softens. If treasury demand softens, yields must rise to attract buyers. Higher yields mean higher borrowing costs. Higher borrowing costs mean higher interest expenses on the national debt. And with $36+ trillion outstanding, even a 1% increase in average interest costs adds hundreds of billions in annual obligations. That is not a theoretical vulnerability. It is mathematical. This is why de-dollarization matters. Not because the dollar disappears tomorrow, but because it removes the structural cushion that allowed the U.S. to run persistent deficits without consequence. The second layer is trade settlement infrastructure. BRICS nations are developing alternative payment systems outside SWIFT. China's cross-border interbank payment system, CIPS, expands yearly. Regional trade blocs increasingly settle locally. Again, none of this replaces the dollar outright, but it reduces friction for non-dollar trade. Once the infrastructure exists, usage grows. Confidence shifts slowly, then suddenly, and that's the dangerous phase. Because once markets perceive that reserve status is weakening, capital flows adjust rapidly. Bond markets move faster than politicians. Currency traders move faster than central bankers. History shows that reserve transitions accelerate once financial markets price in inevitability. We are not at collapse, but we are in transition. And transitions are unstable. The dollar still dominates global reserves, but dominance trending downward is different from dominance expanding. Momentum matters. And in currency systems, momentum often precedes revaluation. What happens at home when reserve, privilege, fades? Most Americans think the dollar is strong because America is strong. But for 50 years, the dollar has been strong because the world needed it. There's a difference. When your currency is the global reserve, you get something economists call exorbitant privilege. It means you can buy real goods from the world with paper claims. You can run trade deficits without immediate consequences. You can consume more than you produce. You can finance government spending cheaply because foreign central banks recycle their dollar surpluses into U.S. Treasury bonds. That system allowed the United States to hollow out manufacturing without facing currency collapse. It allowed persistent deficits. It allowed asset bubbles. It allowed debt expansion that would have destroyed any other country. But when reserve demand begins to weaken, that privilege erodes, and the consequences show up domestically. First, borrowing costs rise structurally. For decades, foreign governments absorbed trillions in U.S. debt because they needed dollar reserves. If they diversify away, treasury demand softens. To attract buyers, yields must rise. Higher yields don't just affect the government. They hit mortgages, corporate loans, auto financing, credit cards. The entire American economy runs on debt. If the risk-free rate rises permanently, asset prices must adjust downward. Second, imported inflation becomes persistent. America imports vast quantities of consumer goods, electronics, pharmaceuticals, and industrial components. If the dollar weakens structurally due to reduced global demand, imports become more expensive. That inflation is not cyclical, it's embedded. You can raise interest rates to suppress demand, but you can't force other countries to price goods cheaper in your currency. Third, deficit financing becomes politically toxic. When interest expense approaches or exceeds defense spending, choices narrow. Either cut spending, raise taxes, or monetize debt through money creation. History shows governments choose monetization more often than austerity, and monetization weakens confidence further. It becomes reflexive. Fourth, asset inequality widens. When currency stability declines, hard assets outperform paper assets. Real estate, commodities, productive land. Those who already own assets preserve purchasing power. Those who rely on wages and savings accounts suffer. That dynamic fractures societies, and currency instability often precedes political instability. Now here's the uncomfortable reality. The Federal Reserve cannot fix structural reserve erosion. Monetary policy can slow inflation temporarily, but it cannot restore global trust. It cannot force Saudi Arabia to price oil exclusively in dollars. It cannot reverse central bank diversification. If reserve status weakens gradually, the domestic economy adjusts painfully. If reserve status weakens suddenly, adjustment becomes violent. Currency transitions are rarely smooth. The British pound didn't collapse overnight after World War II. It declined in stages: devaluations, capital controls, emergency loans, austerity. The public experienced slow erosion, then sudden shocks. The United States still retains enormous advantages: deep capital markets, military power, technological innovation. But reserve currency status amplified those strengths. If that amplification fades, growth must rely on fundamentals alone. And fundamentals require productivity, manufacturing, energy security, fiscal discipline. Without those, the cushion disappears. This isn't prediction, it's structural logic. When global demand for your currency softens, domestic adjustment follows. The question isn't whether change happens. The question is whether it unfolds gradually or accelerates. Watch the capital, not the headlines. If you want to understand system stability, don't listen to politicians. Watch the capital. Money moves before narratives change. It always does. Public messaging says everything is fine. But bond, commodity markets, and central bank behavior tell a different story. Start with central banks. For decades, they increased dollar reserves. U.S. Treasuries were the ultimate safe asset. Liquid, deep, reliable. But over the last several years, diversification accelerated. Gold purchases by central banks hit multi-decade highs. Not small buys, but structural allocations. Countries trusting dollar reserves are increasing hard asset exposure. Why? Because gold carries no counterparty risk. It's not a promise from another government. And when reserve managers favor gold over treasuries, it's not ideological, it's defensive positioning. Now look at sovereign behavior. Bilateral trade agreements are increasingly structured in local currencies. Energy contracts are being settled outside the dollar system in select corridors. These are not yet dominant flows, but direction matters more than size in early transition phases. Next, watch private capital. Large multinational corporations are diversifying currency exposure in their balance sheets. Hedging strategies have expanded. Cash management has become more international. That doesn't mean collapse is imminent. It means optionality is being built. The wealthiest investors think in terms of regime shifts, not news cycles. They allocate across commodities, agricultural land, infrastructure, foreign revenue streams, and precious metals, not because they expect apocalypse, but because they understand that reserve dominance is a historical phase. Now consider something subtle. In prior decades, U.S. Treasury bonds were the automatic default safe haven. But in recent volatility cycles, capital has sometimes moved into gold and alternative stores of value more aggressively. That shift in reflex behavior matters. Safe haven preference patterns reveal psychological confidence, and confidence is the foundation of reserve currency systems. None of this guarantees abrupt breakdown. Reserve transitions historically take years, sometimes decades, but the inflection begins quietly. It begins with incremental reserve diversification, with trade settlement experimentation, with rising hedging costs, with long-duration capital rotating into tangible assets. The headlines lag, capital leads. And when the narrative eventually shifts publicly, the positioning is already done. That's the pattern in every major monetary transition in history. When the Dutch guilder faded, when the British pound ceded dominance, the decline wasn't announced, it was observed. After capital had already moved, the critical question isn't, is the dollar collapsing tomorrow? It's this: are the structural incentives that sustained its dominance weakening? If the answer is even partially yes, capital will adjust long before governments admit it. The life cycle of every reserve currency. Every reserve currency follows a pattern. Not a conspiracy, not a prophecy, but a cycle. It begins with strength. The Dutch guilder in the 1600s, the British pound in the 1800s, the US dollar after 1944. Each rose for the same reasons: economic productivity, trade dominance, military security, and financial credibility. The currency of the most stable, most productive empire becomes the currency of trade. That's phase one. Trust built on output. Then comes phase two, financial expansion. As the world adopts the currency, demand increases. The issuing nation gains advantages. It can borrow cheaply, run deficits without immediate punishment, and expand influence globally. The United States mastered this phase after World War II. Bretton Woods established the dollar as the anchor of global finance. Oil pricing reinforced demand through the petrosystem. Treasury markets became the deepest pool of liquidity on Earth. For decades, this worked. But then comes phase three, overextension. This is where history becomes uncomfortable. When reserve status feels permanent, discipline weakens. Debt rises faster than output. Military commitments expand. Trade deficits become structural, not temporary. The issuing country consumes more than it produces and pays with its own currency. That works until confidence begins to thin. Not collapse, thin. This is where we are today. The dollar still dominates global reserves, still leads settlement markets, and still anchors global liquidity. But its share has gradually declined. That doesn't mean imminent replacement. It means the system is transitioning from unipolar to multipolar. Historically, this phase is the longest and most volatile. The British pound did not collapse overnight. After World War I, it slowly lost ground to the dollar over decades. But the shift became irreversible once Britain's debt burden, military costs, and trade weaknesses exceeded its productive base. Sound familiar? The United States today faces high sovereign debt levels, large fiscal deficits, expanding geopolitical commitments, and political fragmentation. None of these individually destroy a currency, but collectively they change perception. And reserve currencies are perception systems. The key distinction: decline does not equal disappearance. The dollar may not vanish, but its share of dominance can shrink. And in currency systems, even partial shifts create volatility. Reserve status is not lost in a dramatic headline. It erodes through diversification, through alternatives gaining traction, through gradual capital redistribution. The life cycle is not about collapse. It's about relative power. And the dollar today sits in late-stage financial dominance, not early ascent. The multipolar currency shift. If the dollar doesn't collapse overnight, what replaces it? The answer is uncomfortable. Nothing replaces it, not cleanly, not immediately. What replaces a single dominant reserve currency is not another empire, it's fragmentation. And fragmentation is volatile. For decades, the global economy operated under a simple assumption. Trade settles in dollars, energy clears in dollars, reserves are held in dollars, crisis liquidity comes from the Federal Reserve. That centralization created stability. Not fairness, not perfection, but stability. When one currency anchors the system, pricing is simpler, capital flows are predictable, risk premiums remain compressed. Now imagine that anchor loosening. Saudi Arabia accepts yuan for oil. India settles in rupees with Russia. China builds bilateral trade agreements in local currencies. BRICS nations explore settlement systems outside SWIFT. This doesn't mean the dollar disappears. It means the monopoly ends. And monopolies, when weakened, don't transition smoothly. They fracture. In a multipolar system, exchange rates fluctuate more aggressively. Hedging costs increase. Trade contracts become more complex. Liquidity becomes regional, not global. Businesses must manage multiple currencies. Governments diversify reserves. Central banks balance competing monetary blocks. Instead of one dominant pricing unit, you get 3 or 4 competing systems: the dollar block, the yuan-centered block, the eurozone, and commodity-backed bilateral arrangements. And competition between blocks increases geopolitical tension, because currency power is strategic power. If oil trades partly in yuan, that strengthens China's financial influence. If Europe pushes for euro-denominated energy contracts, it strengthens EU autonomy. If BRICS nations build gold-linked settlement mechanisms, it challenges Western banking dominance. Multipolar currency systems historically correlate with higher commodity volatility, trade friction, increased capital controls, more frequent financial crises. Why? Because trust becomes fragmented. When confidence is shared among multiple powers rather than centralized, uncertainty rises, and uncertainty raises costs. The danger is not hyperinflation. The danger is instability, capital flight, sovereign debt repricing, geopolitical leverage battles. The world becomes financially regional rather than globally integrated, and integration has been the foundation of modern prosperity. The dollar may not die dramatically, but if its dominance erodes into a competitive currency landscape, the cost of doing business globally rises, and when the cost of capital rises, growth slows. Multipolar currency systems are not apocalyptic, they are inefficient, and inefficiency reshapes standards of living over time. What happens inside America if external dollar demand weakens? Now let's bring this home. Forget geopolitics for a moment. Forget BRICS. Forget Saudi Arabia. What actually happens inside the United States if global demand for dollars continues to weaken over the next decade? Not collapse overnight, just weaken. Here's the mechanism most people miss. For 50 years, foreign governments, corporations, and central banks have absorbed excess dollars. When the U.S. ran trade deficits, importing more than it exported, those dollars didn't just vanish. They accumulated overseas. And what did foreign countries do with them? They recycled them. They bought U.S. Treasury bonds. They bought U.S. stocks. They bought U.S. real estate. That recycling suppressed U.S. interest rates and inflated American asset prices. It allowed cheap mortgages, low corporate borrowing costs, explosive stock market growth, government deficits without immediate pain. But if global dollar demand slows, that recycling slows too. And that changes everything. First consequence, higher structural interest rates. If foreign central banks are less willing to hold treasuries, the U.S. government must attract buyers domestically. To attract buyers, yields must rise. Higher yields mean more expensive mortgages, more expensive car loans, more expensive credit card debt, higher corporate financing costs. And here's the critical piece. The U.S. government carries over $36 trillion in debt. When interest rates rise structurally, not temporarily, interest payments balloon. That squeezes fiscal space. Meaning, less room for stimulus, less room for social spending, more political conflict over budgets. Second consequence, asset repricing. The American middle class is deeply tied to asset inflation, home values, 401ks, index funds. Those asset values were supported by decades of suppressed rates and global capital inflows. If capital inflows moderate, valuations must adjust, not necessarily crash, but compress. Lower price-to-earnings ratios, slower home price growth, more volatility. That doesn't destroy America, but it changes the wealth effect. For decades, rising asset prices created consumer confidence. If that tailwind weakens, consumption slows. And in America, consumption is the economy. Third consequence, persistent inflation pressure. When fewer dollars are held abroad, more circulate domestically. More domestic liquidity chasing goods creates upward pressure on prices. But unlike 1970s inflation, this wouldn't necessarily be wage-driven. It would be import cost-driven. Remember, the U.S. imports a large percentage of consumer goods. If the dollar gradually weakens relative to trading partners, imports cost more. Energy, electronics, machinery, raw materials, that's not hyperinflation, that's structural cost pressure. And structural cost pressure is harder to fix with interest rate hikes. Fourth consequence, political polarization intensifies. Economic stress always magnifies political division. If borrowing costs rise, if home affordability declines, if purchasing power erodes gradually, public frustration increases, not because of a single crisis, but because living standards feel stagnant. This is historically when protectionism rises, trade conflicts increase, industrial policy expands, central bank independence is questioned. The multipolar currency shift doesn't automatically collapse America, but it removes a privilege, and privileges, when withdrawn, are felt sharply. For decades, the United States operated with a monetary advantage no other country had. It could export inflation and import goods simultaneously. If that advantage weakens, America must operate more like a normal country, produce more, consume less, borrow more cautiously. That adjustment is not fatal, but it is uncomfortable. And discomfort reshapes politics, markets, and expectations. The dollar does not need to die for change to occur. It only needs to lose exclusivity. And exclusivity is already being challenged. Gradual transition or financial shock. Here's the question that actually matters. Not whether the dollar faces pressure, not whether global trade is diversifying, but this. Does this transition unfold slowly or does it snap? History shows both paths are possible. When the British pound lost reserve dominance in the early 20th century, it wasn't a single-day collapse. It was gradual erosion, 2 world wars, massive debt, loss of industrial advantage. And finally, the 1944 Bretton Woods system formalized what was already happening. The pound didn't explode overnight. It weakened structurally. But there's a critical difference between Britain then and America now. Britain in 1945 was physically devastated by war. The United States in 2026 is not. The U.S. still has the largest economy in nominal terms, the deepest capital markets, the most liquid bond market, a global military footprint, the dominant technology platforms. That matters. Reserve currency status doesn't disappear just because alternatives exist. It disappears when confidence shifts rapidly, and confidence shifts when something breaks. So what could trigger disorder instead of gradual adjustment? There are 3 pressure points. First, Treasury market stress. If foreign central banks accelerate selling U.S. bonds, yields spike. If yields spike too quickly, the Federal Reserve faces a dilemma. Let rates rise and risk recession, or intervene and risk inflation. If investors perceive the Fed is monetizing debt permanently, confidence could fracture. Second, a geopolitical rupture. Sanctions have become a weapon of financial statecraft. Freezing Russian reserves in 2022 sent a message to every central bank: dollar reserves can be politicized. That accelerates diversification. If a future conflict leads to broader asset freezes, reserve managers may move faster than expected. And reserve shifts tend to be nonlinear. They are slow until they aren't. Third, a domestic fiscal shock. If deficits expand dramatically during a downturn while interest payments already consume a large portion of federal revenue, markets may begin pricing structural imbalance, not collapse, but repricing risk. And repricing risk increases borrowing costs, which feeds back into deficits. That's how currency stress compounds. But here's the counterweight. America still benefits from inertia. The dollar dominates because oil contracts are priced in it. Global debt is denominated in it. Trade finance is settled in it. SWIFT and clearing systems revolve around it. Replacing that infrastructure is not simple. BRICS discussions about alternative settlement systems are real, but building liquidity and trust equal to U.S. markets takes decades. That means the most likely path is not sudden death. It's gradual erosion. Less share of reserves, more bilateral trade outside the dollar, more gold accumulation, more regional currency blocks. That doesn't mean collapse. It means diminished exclusivity, and diminished exclusivity reduces privilege. The United States won't wake up one day with the dollar worthless. It will wake up year after year with slightly less leverage, slightly higher borrowing costs, slightly more volatility. Empires don't always fall in explosions. Sometimes they descend in slow adjustments. The real determinant is this. Can fiscal discipline, productive capacity, and monetary credibility be restored before confidence shifts too far? Because once credibility breaks, it doesn't rebuild easily. What this really means for power. So where does that leave us? Not in panic, not in collapse, but in transition. The end of the Petrodollar agreement doesn't automatically mean the dollar dies tomorrow. It means the privilege that sustained American dominance for 50 years is no longer guaranteed. And privilege, once questioned, changes behavior. For decades, the United States enjoyed structural advantages. It could run chronic deficits without immediate punishment. It could export inflation while importing goods. It could finance wars and social programs simultaneously. It could borrow at rates lower than economic fundamentals justified. That wasn't magic. It was demand. Artificial, oil-backed, reserve-driven demand. If that demand weakens, the system doesn't implode overnight. It recalibrates. Higher borrowing costs, stricter fiscal choices, less room for policy mistakes, greater global competition. The real shift isn't monetary, it's geopolitical. When the dollar loses exclusivity, power disperses. Regional blocs gain influence, commodity producers gain leverage, emerging markets negotiate harder. The world becomes less centralized and more transactional. That doesn't mean America collapses, it means America competes. And competition requires productivity, it requires industrial capacity, energy independence, technological leadership, fiscal discipline. Those are economic fundamentals, not currency privileges. History shows reserve currencies fade when confidence fades, but history also shows nations that adapt can remain powerful without dominance. The question isn't whether the dollar vanishes. The question is whether policy adjusts before credibility erodes too far. Because credibility is everything in finance. It's not the printing press that sustains a currency. It's belief. If belief stabilizes, the dollar transitions into a shared global role. If belief fractures, volatility accelerates. That's the fork in the road. This isn't doom forecasting, it's structural analysis. The petrodollar system created an era of extraordinary American leverage. That era is shifting. And understanding the shift gives you clarity while others react emotionally. If this breakdown helped you see the bigger picture, beyond headlines, beyond noise, then hit like. Subscribe if you want deeper pattern-based economic analysis without hype. Because the future isn't random. It follows incentives, power, and math. And when you understand those forces, you're not surprised by the next move. History doesn't repeat perfectly, but it rhymes loudly, and we're listening.